All right, welcome to Talk Tickers, the show where we slice and dice the earnings calls that are moving markets. Today, we're diving deep into Synchrony Financial's Q3 2025 results. Let's get into it.
So here's the big question right off the bat. Synchrony absolutely crushed their profit numbers. I mean, a huge beat. But the market kind of shrugged. So what gives? Why the quiet celebration? That's the core puzzle we're going to unpack today.
Okay, first things first, let's look at those headline numbers. And trust me, they were pretty impressive.
They came in with GAAP earnings per share of $2.86.
Now get this. That wasn't just a beat, it absolutely smashed what analysts were expecting. We're talking a full 29% above consensus. That's a monster beat in anyone's book. And as if that wasn't enough, management put their money where their mouth is. They added another $1 billion to their share buyback program. That brings the total war chest to a whopping $2.1 billion. That's a serious vote of confidence.
So, as you can see, this wasn't just some one-trick pony with the EPS number. No. They also squeaked past revenue expectations, and what I really like to see is that purchase volume was up a solid 2% year over year. That tells you that people are still swiping those cards, which is exactly what you want to see.
Okay, so the numbers look fantastic on the surface, but you know us, we always want to know the why. What was the story from management? What's the narrative they're pushing? Let's get into their playbook.
Well, CEO Brian Doubles really hammered home the idea that this was a fundamentally strong quarter. He pointed to some really powerful profitability metrics, like a return on tangible common equity hitting over 30%. That's a seriously efficient business right there.
And this right here, this is where we get to the heart of the matter. It's a tale of two stories. On one hand, you've got this incredible profitability, just stellar returns. But on the other hand, they're tapping the brakes on their outlook, trimming their revenue forecast for the year, and you gotta ask, why? Well, it's almost ironic. They said it's because their credit is performing so well. Fewer people are late on payments, so they collect less in late fees. It's like they're a victim of their own success, at least on the top line.
So their playbook is pretty straightforward, really. Number one, keep a tight leash on credit. And frankly, that's been working out even better than they thought. 2, pour fuel on strategic growth engines, big new programs with partners like Walmart and Amazon. 3, keep investing in their digital game to keep people engaged. And number 4, and this is a big one, take all that cash they're making and give it right back to shareholders through those buybacks.
All right, so that's the company's story. Strong, disciplined, profitable. But did the market buy it? How did investors react to all this? Let's take a look.
Well, not with a bang, that's for sure. The stock barely budged, just a little pop of about 1.6% in the pre-market. For a beat as big as this was, that's pretty quiet.
And that price action tells you everything you need to know. It says the market heard the huge profit beat, saw the buyback, and said, yeah, that's nice, but what about that trimmed revenue guide? Wall Street is always looking forward, and right now it seems more worried about future growth than it is impressed by past profits.
So yeah, the market's reaction feels a little underwhelming, right? So let's pull back the lens a bit. Let's put this performance in context and see how Synchrony has been doing against its peers. Now this is fascinating. If you just look at the last month, yeah, they're lagging a bit. But zoom out to the one-year view, wow. Synchrony has delivered double the return of the overall financial sector. So despite the short-term noise, the long-term picture has been incredibly strong.
Okay, so we've looked at the numbers, we've heard from management, and we've seen how the market reacted. Now it's time to put it all together. Here's our take on what comes next.
So, the big question is, what's the play here? How should we be thinking about this stock going forward?
All right, here it is. We're calling this an outperform. We think the market is getting this one wrong. It's undervaluing just how durable Synchrony's earnings power really is. So here's our thesis broken down. Step 1, we think the market is hyper-focused on that trimmed revenue guide, but that's a good thing. It's a sign of strong credit management, not weakness. Step 2, that $2.1 billion buyback is no joke. That is going to provide a massive and growing tailwind to earnings per share. Step 3, the real growth catalysts, things like the big new Walmart and Amazon programs, haven't even really kicked in yet. That's all future upside that we don't think is priced in. So, step 4, our prediction is that the stock will re-rate higher. Eventually, the market is going to shift its focus away from that revenue guide and wake up to the powerful combination of earnings growth and aggressive capital returns.
And of course, we have to say it, this has been our analysis of the earnings call. It's for informational purposes only. It is absolutely not financial advice.